Welcome back to Global Money Talk live from the New York Stock Exchange. The Federal Reserve voted to cut the Fed funds rate by 50 basis points at the end of its September meeting, while updated projections indicate another 50 basis point cut by the year end, with total cuts reaching about 100 basis points through 2025. The forward guidance does give markets a clearer outlook on future cuts, providing certainty for investors. So will the commercial real estate industry in the U.S. see a turnaround in terms of transaction volume on the heels of the Fed's latest move? The Fed will also continue quantitative tightening. While joining me here for today's market insight on commercial real estate is Raiman, REIT expert at LDR Capital. So thank you so much for joining me.
Very nice to see you today.
Well, you're joining me at the end of the third quarter, about to head into the final quarter of this year. So I do want to hear about the landscape for commercial real estate as it stands, especially on the heels of the latest Fed rate announcement.
Sure. So commercial real estate is so important because it is the fourth largest asset class in the country, behind the equities market, behind the residential real estate market, and behind the U.S. Treasury market. Backing commercial real estate are $6 trillion of commercial loans. And those loans are very interesting because they are very different than residential mortgage loans. Someone buys a house in the United States, they generally get a long-term fixed rate mortgage, 10, 20, 30-year mortgage, fixed rate, and as part of the monthly interest payment, they will also amortize down or pay down that mortgage balance. The commercial mortgage market is very different in that these are generally shorter-term mortgages, 3, 4, 5, or 6 years, all interest only, with no amortization or pay down of the principal balance over the short term, which means that a landlord will pay interest for 3 or 4 or 5 years and then have a balloon payment to pay off the entirety of the loan at the back end when it matures. Well, the $6 trillion mortgage market, about a third of it will come due in the next 3 years. So close to $2 trillion of mortgages and loans will come due this year, 2025, and 2026. And what's happened in the marketplace, because in 2022 the Federal Reserve raised interest rates so high, that had an adverse impact on commercial real estate values. So the loans to value, which were originally 60% of value for commercial mortgages, rose to 60, 70, 80, 90%, if not 100% of value. So now you have a dialogue going on between landlords and lenders, where the lenders say, we gave you a loan, it was 60% of the value of the office building or the shopping center. Well, that's now 80 or 90%. You need to cure me because you are in default on your mortgage. So one of three things can happen. A landlord can say, no, here are the keys to the property, you deal with it. It could say, sure, I've got cash in the bank, I'll pay down the loan and get you back in compliance. Or the landlord can say, let's talk, let's negotiate, let's figure it out. And all three of those doors are being entered depending upon the type of property, depending upon the location and the market. And the predominant share of assets are being negotiated. I'll give you a quick example. A friend of mine is one of the largest landlords of industrial buildings across the country. He has a property that he got a call from his lender to say, your loan is way too high now relative to the value of the building. My friend said, the building's full, the parking lot's clean, the roof is good, the tenant is happy, it's fully occupied. What else can I do as a landlord? And the lender said, all right, let's talk. Let's figure it out. Give us some dollars, we'll extend the loan, we'll kick the can down the road, and that's great. Where the problem resides is where the landlord says, I don't want to own the asset anymore. It's a tired office building, it's an old apartment building, it's a hospital where the hospital chain is no longer operating. We don't want it anymore. And that's where the defaults will occur, which create both risk and opportunity in the marketplace.
And so, Larry, you just mentioned the different options, the different negotiations that are taking place. And in this post-pandemic environment, if it does come to that last option, walk us through what actually happens there.
So in the event of a disconnect between the landlord and the lender, where the property is not desired anymore by the landlord, the bank, which is 50% of the lending market, or the life insurance company, or the securities market in the hedge fund world will take the asset over, and they'll have to do something with the asset. Now, if the asset is a good quality location but an old asset, they may put some money into it and re-merchandise it. Take an office building and make it an apartment house. Take an office building and make it a high-rise industrial building. Take a regional mall and make it into a multifamily residential community. Or if there is no value for the product, raise the property and you buy for land value and then figure out what to do with it. So in all cases, it really comes down to what's the location of the piece of real estate that is in default, and is there a remerchandising, a renovation, a recalibration of it to make it useful again.
And Larry, I think you've walked us through some examples, and you're highlighting both the opportunities as well as the risks out there when it comes to the current environment. And as we continue to move forward through this Fed rate cycle, we'll see what this means for the commercial real estate sector. But can you also walk us through the different types of product out there right now that you're keeping your eyes on?
Sure. So the commercial real estate marketplace is broad, and there's a large spectrum of different types of properties. There's the traditional 4 food groups. There's office, industrial, multifamily properties, as well as retail shopping centers. But then there's all kinds of other properties as well. Hotels, hospitals, self-storage facilities, data centers, towers, and on and on and on. When you look at the commercial real estate pie, about 20% of it is commercial office. The remaining 80% are these other categories. In the public marketplace for real estate investment trusts, only 3% of the market capitalization is office. The remaining 97% are other product categories. And what you're finding in today's world is, while there are stresses and strains in the office market, if you like, we can chat about it, the other property categories are doing very well. If you own an industrial building today, you're getting rent growth. Your building is full because of online retailing. If you look at the apartment marketplace, where we are underserved from a housing perspective in this country, and for sale housing is quite expensive today, unfortunately, for many folks who want to buy a home, people are renting for longer, which means rents are going up and occupancies are full. And when you go through many of the different property sectors, the data center sector is a $6 billion sector, and it's supposed to be $21 billion in the next 10 years. We're consuming demand, we're consuming data, we're consuming broadband, and that's only going to grow. So in many of the property sectors, the operating results are quite fine. And it's a matter of the one kind of area that is a sore thumb in commercial real estate now, which will be for a period of time, is the office marketplace, which is challenged and likely to be challenged.
Of course, and I think you helped us understand what the categories are when we're talking about commercial real estate. And as you mentioned, throughout the pandemic years, we've seen a shift when it comes to how people commute, whether they work from home, and in this current environment, we're hearing about companies demanding their workers return to the office. So I do want to zoom into the office before we take a look at the other product categories, because as you mentioned, when it comes to data centers, there is a lot of demand, especially given the rise in demand for AI. So we know what that means. But first and foremost, when it comes to office, we know that here in New York City, even down on Wall Street, outside the New York Stock Exchange, it isn't what it used to be. So break it down for us when it comes to different regions throughout the country for office space.
Sure. So there's overall in the country about 1 billion square feet of office across the country. New York being the largest office market, but substantial office markets in Boston, Chicago, the main San Francisco, Los Angeles, Miami, Dallas, Houston, some of the main metro markets. And what we're finding is the nationwide office market has risen in vacancy to 20%. And when you look at that broad nationwide, we'll get to individual markets in a second, is you need about an 80% occupancy rate to break even because of the engineering costs, the staffing costs, the tenant concession costs, the renovation costs. To keep a building current, you need an occupancy rate of 80%. Well, with vacancy rates of 20%, a lot of landlords are just breaking even in their office investments. And what's happened is when you lift the hood up and look one level deeper, you find that some markets across the country are doing quite well, like as an example, Park Avenue. If here in New York City, if you go from Grand Central to 59th Street on Park Avenue, rents are $250 a square foot and you can't find space. But if you go 2 or 3 avenues over, or 2 or 3 avenues over east or west, you find landlords are giving space away. And what's happening not only just in New York, but also in Chicago and in San Francisco, which is a distressed office market, Los Angeles, a distressed office market, you find slices of the market in severe distress, and then you have other parts of the market which are actually quite strong. So West LA as an example, quite strong. Downtown LA, very, very weak. The same thing is in the case of Miami and Chicago. So in the office market, no matter where you are across the country, the key is that there is a dispersion of operating performance and demand within each of those markets, where there are slices that are extraordinarily in demand. In fact, there's probably more demand than supply. And in other markets, there's no bid for that space. And the challenge for landlords is to focus your investments on those slices of the market that are in demand. And if you have an asset that is elderly, that the market's moved on it, maybe raise it and build an apartment building out of it, or take it into an industrial building, or find some other alternative use. And that will get the office market, which is so much available space, into an equation where the supply is back in sync with demand. That's going to be a 10-year cycle.
Yeah, I think it's very helpful to learn about this and see what's happening across the country, because we read about the headlines, the news about certain areas of the country that are experiencing distress when it comes to office space, and when it comes to building owners choosing to walk away from their properties due to some of the challenges out there. Tell us why this is happening.
Well, it's happening because at the end of the day, they don't have the capital to reinvest in their property, or they don't have the long-term vision for the property. And the lender is basically putting the screws to the landlord to say, pay us back. And the landlord saying, no, we don't want this asset anymore. Now, it comes with particular pain, because oftentimes landlords have depreciated their asset, which means their basis is reduced. So if they turn back the keys to the property that they owned to a lender, they might have deferred capital gains that they'll have to pay taxes on. So oftentimes when a landlord turns a key back, it doesn't come for nothing. It comes with a cost, and that is embedded taxable loss or gain that they have to pay back to federal government in taxes, and they've lost their equity as well. So ultimately, when an asset is given back, it really has to be a severely impaired asset where the landlord says, even though I have to pay money to give the keys back to my lender, I'm still going to do it, because that means I'm going to lose even more money by owning the asset. So what that means for the person who eventually takes over, the institution that takes over the asset, is they need to get it at a very low basis, because by definition there's deferred maintenance, there's embedded costs to the asset, maybe there's taxes to pay to the municipality that have not been paid for many years, there's tenant concessions that have to be given. So all of those embedded costs have to be borne by the new owner, which means the owner is going to want to price that asset at a very low level. And that's a very hard discussion to have, but right now that's underway in many assets.
Absolutely. It is indeed a difficult conversation to have, but it does fit into the overall accounting equation. And before we move away from the office sector when it comes to commercial real estate, I do want to ask you what's really happening in terms of the badge swipes into office buildings, this trend of working from home. Do you think this is going to make a difference with more employees working away from home and back in the office place?
Very much so. We are in a secular decline for office space. Because of technology today, we can work remotely as easily as work in the office. Now, we lose the collegiality and the communal nature of conversation, that the interpersonal conversation is more valuable than anything. But people want to have flexibility in their lives. So what that means is there has been a secular shift away from the utility for commercial office space, which is why vacancy rates have risen to 20% and may even rise higher. So what that means is we need to have less supply. It means that people will want to work from home more frequently, maybe Mondays and Fridays, and work in the office Tuesday, Wednesday, Thursday. And at the end of the day, it's going to be a conversation between employers and employees as to what the right balance is between the two. I mean, certainly working in the office is very important for younger employees to learn from their more seasoned counterparts and how to manage their business, how to manage their career, and how to progress within their career. You can't get that remotely. But at the same point, people want flexibility. They want to be able to work remotely. And that's where we are now finding our way in the office utility space. It's kind of similar. There's an analogy with the regional mall business of many, many years ago.
Yeah.
Where there were 1,600 malls many years ago, and then what happened? We started shopping online.
Yeah.
And now the utility of bricks and mortar retailing has gone down. So what's happened? We now have 1,100 malls, not 1,500 or 1,600 malls. We've de-malled 500 malls in this country, and it's probably going to be less than 1,000 soon. So the amount of supply of malls has reduced to meet the lower level of demand for going to a store and shopping. We're now doing it online. The same analogy is holding true for the office space. We're not going to the office as much. We're working from home a little bit more. We're creating a better balance between work and life, and that requires less office space, and it's going to be a similar decade's worth of rationalization of this office space to meet the current run rate, if you will, of people working in the office and out of the office. And that'll continue for a while.
Yes, I think that's a great analogy for us to refer to, because we think about the advent of online shopping and e-commerce, and before we had that, we actually had to walk, drive, commute to the shopping mall and to actually do our shopping instead of pulling out our smartphones and placing all these orders online.
Tremendously so. And that's changed. And now this is the new reality. It was a secular shift in the manner in which we shop. Now, we still like to go to stores, touch and feel, look at the different inventory, speak to a sales representative and fare what's best for me. Great. There's a place for bricks and mortar retail. It wasn't what it once was. Same holds true in office. There's a place for office work where we can speak, we can talk. You and I are speaking now. It's a much better conversation in person than it would be electronically, which is wonderful, and thank you for this.
Of course. Thank you, Larry.
And that's the case. And so there's a place for office space, but less so. And that's what we're now living through. And that displaces valuations, it displaces a lot the lending market, and it'll be ironed out. And that's what creates opportunity and risk in the market. There'll be some very crafty landlords and hedge funds and entrepreneurial real estate managers that see an office building that's underutilized and say, you know what, I can change that. I can change the merchandise mix of that building and get real value out of it. Put a supermarket in the basement. Put a healthcare facility on the third floor, whatever the case may be, and get greater utility out of that bricks and mortar where we can no longer get it in more traditional office space.
Well, absolutely, Larry, and I'm interested to see what comes out of all of this, especially in a city like New York City, although there are zoning complications with some of the buildings, but of course it'll be exciting to see what comes out of this. And speaking of opportunities, I do want to take a look at life science hubs across the country, because the United States is such a big country and we have different regions and different cities are seen as life science hubs. But I understand there has been a decline in demand, especially as we head further into 2024. So what's going on there?
So it's a very interesting subcategory of office. It's essentially a specialized office composition. And we've seen, up until over the last really 2 years, tremendous growth. Venture capital funding for biotech and for emerging healthcare providers. And that drove a life sciences office market to a great degree. And the reason why it is a subcategory of office is that the type of square footage and footprint of a life science building is very different than a traditional office. With a traditional office footprint with maybe a bulk common area, in the life sciences space you need lab work. You need medical practitioners doing testing and programming, so it's a much higher finish, whereas a traditional office building may cost $300 to $400 a square foot to provide really good finish and environment for a traditional office worker. It may be $1,000 a square foot for a life sciences building. And with the venture capital market drying up to a great degree, a lot of the small and emergent healthcare and biotech and new healthcare technology companies have lost capital provisions to build and grow and occupy more space. That came at a time where there was a tremendous glut of new development. So right now in the marketplace, occupancies were at 1.97% across the life sciences area. Now that's fallen by close to 10 percentage points. So now you have much more space available, and you have a lot of new space coming online, and there's discussions about probably a 4 or 5 year glut of excess supply in the life sciences market. So we personally believe over the short term there is risk in that market where operating fundamentals will be a bit challenged. If you can look through the next several years, there will be a long-term demand for the space as we continue to grow our need and necessity for greater and greater medical technologies. So we are bullish on life sciences over the long run. We're a bit less bullish over the short term while we get through this supply glut.
And Larry, now that we've covered the office sector when it comes to commercial real estate, I think it'd be helpful for the viewing audience to learn a little bit about the main categories of REITs when it comes to equity, mortgage, hybrid REITs. Can you explain the different types of REITs?
Sure. There are essentially two basic types of REITs. One are equity REITs that own all the traditional equity real estate, office, industrial, shopping centers, apartment buildings, hospitals, hotels, self-storage facilities, and data centers, and on and on. And then there are mortgage REITs. Mortgage REITs provide loans to users, whether residential, in the residential market, they're called residential mortgage REITs, or in the commercial market, commercial mortgage REITs that put mortgages on commercial office buildings and other commercial real estate. And the overall public real estate market is over $1 trillion of market capitalization, and only 3% of it is the office market. The remaining 97% are these alternative categories. And we do cover all of those areas by having management meetings and company visits and listening to their earnings calls. And by and large, what we found is that the pandemic caused some of those companies to have a stoppage. The shopping center companies, a lot of the retailers, closed their doors temporarily. The hospital chains, people couldn't visit their loved ones in hospitals, so there was difficulty having entrance into the hospital chains. Certainly the hotel sector was shut down while there was a nationwide ban on travel. So since that time, there has been a recovery in most of in those property areas where things have come back into good standing. And the one area that has lived through a very consistent growth is the industrial marketplace. When we were sitting in our homes and our apartments and we unfortunately were quarantined, we were shopping online and we were getting goods sent to our houses. So the industrial market remained really tight during that period of time. The other market that remained very tight is the apartment market, because single family houses are still very expensive and people are renting more and more for longer and longer. And the market's been considerably tight for a period of time. So both of those areas are 96-97% occupied with continuous rent growth. Those two areas remain pretty stable and steady all through the while, where some of the other markets have had a bit of a rockier path, but now getting back towards resiliency.
And you brought up the demand for industrial space, especially during the pandemic. And as you mentioned, we're all sitting at home and we did have the convenience of shopping online. But I remember hearing about how drones are being utilized for people who wanted to take a look at industrial spaces, but go sight unseen to see if those spaces would be suitable for them. So I think it really does speak to how technology was maximized during that period. And as you mentioned, demand for data centers. So before I get to that, I very quickly want to ask you about the differences between publicly traded, public non-traded, and private REITs, especially since we're here at the New York Stock Exchange.
Sure. So we focus on the public real estate market called the Real Estate Investment Trust area. And there are differences and similarities between the public real estate market and the private real estate market. A similarity is they own similar assets, commercial real estate. The underlying collateral is similar, although in the private market it's much more heavily weighted to the office market than in the public market, which is very minority exposure to the office market. But generally speaking, the collateral is commercial real estate, collecting net rents and paying it out to investors, whether in a private structure or a public structure. But that's where the similarity ends. The difference is in the private market, a private market where you and I to go buy a commercial property, whatever it may be, we'd put some cash down and we'd get a mortgage and we'd finance that asset as an asset. The public market has pooled financing, where they will pool finance their entire portfolio of assets as a collection rather than individual assets. And the leverage levels of the public companies are only about 35%. Versus in the private market, leverage levels of 2/3, if not higher. So in the public market, with a 35% leverage level, that means 2/3 of their assets they own free and clear. So if they have a hard conversation with a lender, hey, by the way, we gave you a loan and now the loan to value is a bit too high, well, we can go as a public company and tap the capital in unencumbered assets that we own free and clear, get a small mortgage on that and repay the lender, and that way we can pool finance our assets. So, and also the public companies have, by definition, we're here sitting in the New York Stock Exchange, access to public capital. There's two companies doing public equity offerings today. They can raise public debt, they can raise preferred stock. So this year alone, the public REITs have raised almost $50 billion of capital. That creates tremendous liquidity, and they're able to do it because they have low leverage, there's transparency, there's governance of the public companies. So by and large, the public companies don't have the stresses and strains of what's happening in the private marketplace right now because of their access to public markets and the manner in which they structure themselves.
And Larry, I think that was a very helpful overview of what's happening, but I do want to very quickly get to data centers. So here we are at the New York Stock Exchange, as you mentioned, and everything hinges on data. But to be able to access that data, to store it, to process it, we need data centers. So tell us what's happening when it comes to that area of real estate.
Tremendous growth. Simply stated. The nature of data centers is a couple-fold. These are bricks and mortar pieces of real estate, but they're located on energy hubs where they can tap into energy hubs, and with high finish, high you need to have certain temperature control. So all of this, so it's a very high finish, specialized building that can deliver energy real time to the New York Stock Exchange, to high broadband users. And by and large, it's a very in-demand area that is continuing to grow, particularly in metro markets like Phoenix, which has robust growth, and Miami, San Francisco, LA. So the major markets where you have tremendous demographic growth, we're seeing huge demand of data and broadband capability and requirements that needs to be delivered. So the marketplace is going to see asset growth, both in the form of asset value accretion, but also new assets delivered to the market. So there's going to be a tripling of data center value in this country over the next 10 years, simply because of the value growth and the increased demand for space. And that's not going to change, and most of the new space will be developed. Very difficult changing an office building and make it a data center. The finish won't be good enough. It won't be located where there's an energy hub to deliver the broadband energy for AI or for 5G or maybe even 6 or 7G down the road. So it has to be a particular location with a particular type of building delivered close to a metro market where the consumption of this broadband is so prominent.
And Larry, we have about less than 2 minutes here, so before I let you go, building on what you just said, where do you see the opportunities in the CRE space right now?
So opportunities span the horizon. If you're an entrepreneurial real estate entity, you could buy an older office building and turn it into a newer office building. Or you could take an older office building at a very low basis and turn it into a high-rise apartment house. You could take a cash-flowing, long-term leased property, because interest rates are higher. You could buy a long-term lease, own it passively, and get a very high yield on your cost, and have that in excess of your cost of capital. So the span of opportunity ranges based on the asset type. We are structurally underhoused in our country, so apartment houses and multifamily communities will be, in our view, full for a long period of time, which generates demand for higher rents and cash flow over time, which is wonderful. So the opportunities are very specific to the property market and the location. I would say if you put it on the spectrum, you could have entrepreneurial upside and opportunity within the office space, given the dislocation occurring. You could have consistent return on investment in some consistent markets, such as industrial or apartment houses or community centers. And you could have very stable income oriented from long-term leased real estate for 20 years.
Okay, Larry, well, thank you so much for such an interesting conversation into commercial real estate. I appreciate all of your insights today.
Thank you so much.
Thank you.